Pierre-Olivier Gourinchas, the chief economist of the IMF, thank you so much for your time. Really appreciated. You today released your updated World Economic Outlook report with some pretty significant downgrades. Talk us through the main points.
Yeah, so what we are seeing is, of course, the impact of the trade tensions that have erupted since late January. And really there is a huge amount of uncertainty in the global economy right now. So even for ourselves, in terms of figuring out where the global economy is going, we had to take a slightly different approach than we usually do. So instead of having a baseline around which we anchor our projections, which typically takes policy actions that are pretty firm, there's so much uncertainty going forward that we decided to have instead what we call a reference forecast. And we basically established that reference forecast based on all the policy announcements up to April 4th. So that's after the Rose Garden announcement on April 2nd by the US administration. And then we looked at the world based on this set of assumptions. And what we see is a fairly significant downward revision for growth in 2025 and 2026. We're seeing growth at 2.8% this year and going back to 3% next year. But overall, the cumulated downgrade is 0.8 percentage points. So that's quite significant.
It's the biggest downgrade, or the slowest growth rather, since the COVID pandemic, the second slowest growth since the great financial crisis. How critical is this juncture for the global economy?
Well, it's quite critical because, of course, things could go and get worse if the trade tensions escalate further. I think everyone is kind of waiting to see where things are going to go. And that uncertainty is actually also a factor that is leading businesses to suspend investments, suspend purchases, decide to wait and see. Everyone is waiting and see. And that's never good for growth. So we're seeing that. We're very concerned that even with the pause that was announced on April 9, because that pause lowered tariffs on a large number of countries, but it really ramped them up against China and with countermeasures adopted by China as well. And so under that alternative path, this pause scenario, even if extended permanently, we still see a very sharp slowdown in global growth. Now, I should point out immediately, this is not a global downturn. What we're seeing is not on the scale of what we had during COVID or the global financial crisis. It's a sharp slowdown, but it's not a downturn. But the risk of a downturn have increased, and we estimate that there are around 30% now. That's up from around a little bit more than 15% back in October. So that's, those risks have doubled.
And by downturn, you mean outright recession?
By downturn, we mean at the global level, what we typically have as a reference point is 2% growth rate. 2% growth rate historically happened 4 or 5 times in our, since the 1980s or so. And it tends to be associated with most advanced economies in recession and most emerging market economies having a significant slowdown. So now it's not all countries in recession, but it's really something that you see very rarely.
Now it's interesting, you have obviously quite dramatically downgraded the growth forecast for the US, but you're not forecasting a recession, and you're a little bit more positive than some of the Wall Street banks when it comes to US growth. Why?
Yeah, that's right. So there's a significant downgrade here. We are projecting 1.8% growth in 2025. That's 0.9 percentage point lower than what we were projecting back in January. So that's a significant slowdown for the US economy, no doubt about that. But 1.8 is not recession for the US. And the reason for this is there was quite a bit of momentum and quite a bit of strength in the US economy coming into 2025. And this is an economy that was, doing very, very well, very strong labor markets, strong growth, strong productivity growth, lots of capital inflows. If you roll back the clock and think about what the narrative was about the US just a few months ago, everyone was trying to emulate. And so there is some correction there. Not all of it is the tariffs. A significant part of the downward revision we have of this 0.9 percentage point is actually a cooling off of the US economy on its own. We've seen signs of weakening confidence, consumer confidence, earnings numbers that have been coming in and a bit disappointing. All of this is even before the tariffs announcements. The tariffs announcement by themselves, in our own analysis, they contribute about 0.3 to 0.4 percentage point to that 0.9 overall.
Let's talk about the other adversary in that Chinese-U.S. trade war. China, of course, you downgraded the forecast to 4%. The official growth target, of course, is 5%. How badly will the Chinese economy be hit, given that you haven't factored in what came after April 4th just yet?
Yes, so this is as of April 4th. And what we are saying for the Chinese economy is an impact of the tariff that is quite sizable. So the Chinese economy is an export-oriented economy. They do a lot of trade with the US, with other countries. The tariffs are, if they remain in place, even at the level of April 4th, would hit the Chinese economy pretty severely. In our estimate, again, that alone would be about 1.3 percentage point downgrade. Now, why do we project only 0.6? We are projecting to go from 4.6 to 4. That's a 0.6 percentage point downgrade for China in 2025. Well, because other things are propping up the Chinese economy a bit. In particular, the amount of fiscal support they've announced since the beginning of the year, and some of that in the end of the last year, and some of that is providing some buoyancy to the Chinese economy. And when you compare the US and China side by side, it's actually quite instructive. What you see in the US and China is a hit to global output, but very different impact on inflation. Inflation in the US revised upwards. We're expecting inflation to actually not decline this year compared to next. 3% inflation in 25, 3% inflation in 2024. We were expecting to be back at central bank targets. We're 1 percentage point away. In China, an economy that has been suffering from weak demand for a while and been flirting with low inflation numbers, the impact of the tariff is bringing inflation down further. We're expecting 0% inflation, basically borderline deflation for the Chinese economy. So very differentiated impact when you look at inflation.
And that's something the Chinese economy has been contending with for the better part of the last year anyways. We have to talk about Europe, because something that struck me about your forecast for Europe was the fact that the UK economy was downgraded the most. Why is that?
Well, so the UK economy has been downgraded about 0.5 percentage point, if I'm not mistaken. And there is some impact of the tariffs and some impact of uncertainty. Uncertainty is hitting everyone. The tariffs are hitting most economies. But the downgrade in the UK is also coming from somewhat weaker economy towards the end of last year, and the carryover from that weak momentum into 2025 leads to a lower number for growth in 2025 in the UK. We've also seen interest rates increasing in the UK, and that's tightening financial conditions. So even if the Bank of England is in the process of gradually easing monetary policy, there's been some tightening of financial conditions that's also weighing on the outlook. So some UK specific factors there.
Pierre-Olivier, paint a picture for us as to where globalization stands after the onset of this trade war. Is it a further increase in globalization because everyone is trying to now increase their trade ties with each other? It's just globalization on steroids minus the US? How would you characterize it?
It's very hard to figure out where we're going to land. But let me describe what we're seeing in terms of our projections for the near term. Up until last year, trade in relation to overall activity, so the ratio of trade to global GDP, has been fairly steady, bobbing up and down, coming down during COVID and bouncing right back up, coming down during the global financial crisis, coming right back up, but fairly stable. It's not been increasing like it was over the years from 2000 to, let's say, 2008. So we are not in the period of hyperglobalization, we're in the period in which things were kind of steady. Now, what we're saying when we look ahead is we're expecting that there might be some decline in that ratio of trade to global activity. So in other words, some amount of deglobalization is what our forecasts are telling us. And that is going to be coming from some unwinding of those deep trade relations that are existing. You know, think about the global supply chains that are linking the US and China in very complex ways, often with third countries. Some of that we're expecting is going to be unwound one way or another. That's going to affect the process of globalization. You're right that some other countries may pick up some of the slack, but that's going to take time. It's going to be complicated. It will depend on whether there is enough predictability, transparency, clarity in the trading rules that will emerge from the situation we're in. And we all have to hope that at some point there will be some transparency, predictability, and clarity about the trading rules, so that businesses can make their investment decisions, multinational corporations can decide how to organize their supply chains. We're not there yet.
Right.
But at that point, some countries might benefit, but overall, we expect the level of globalization to decrease.
And finally, where does all of this leave the US dollar? Because obviously there is a loss of trust in US assets, as we've seen over the past couple of weeks, a loss of trust in US leadership. Is the dollar still king?
Well, so what we're saying in terms of the dollar, you have two forces going in opposite directions. One, you have the tariffs. In past episodes, when the US would impose, for instance, tariffs on China a little bit less than 10 years ago, what we saw was an appreciation of the dollar against the Chinese currency. So a lot of people were expecting that this round of trade measures would lead to an appreciation of the US dollar. We've seen the opposite. Why is that? Well, there are the forces that we can point to are weaker growth prospects in the US, a lot of uncertainty about policy going forward. And that leads to a reassessment about the demand for global dollar assets, not just about bonds, it's bonds, equities, all kinds of dollar assets. Now remember where we're starting from. The narrative a few months ago even was about the strength of the US economy, tremendous amount of capital flowing into the US, going to equity markets, but also going to bond markets. So there is some reassessment of that. What we're seeing is some rebalancing. The markets are adjusting, the valuations are adjusting, the currencies are adjusting. All of this to us at this point seems fairly orderly. So we're not seeing a major change in the system.
So the US dollar remains the world's reserve currency, you think?
At this point, certainly.
Pierre-Olivier, thank you so much for your time. Really appreciate it. Thank you.
Thank you.